Thank you for your time this morning. I'm just going to run through very briefly the FY18 results and a couple of other more recent events that have occurred, but I'll just give you a very quick background. So GDF, or Garda Diversified Fund, it's about $330 million of AUM and about $180 million worth of market cap. The assets are commercial industrial assets located along the eastern seaboard. About 60% of our assets are here in Queensland and 40% in Victoria, and about a 2/3 split to commercial, 1/3 split to industrial assets. You'll see the portfolio has just under a 6-year WALE and is 95% occupied. Rent increases across the portfolio at about 3.25%. Gearing currently sits at about 37%, and NTA is just a shade under $1.30. As the introduction was just given, the current trading price sees as a yield at just over 7%, and you'll see a little further in the presentation that last year that was at about a 65% tax deferred rate for the period. Garda Capital Group is also the manager and largest investor in the vehicle, about a 13.5% stake, giving us material alignment with our investors in the fund. Highlights for the year, we've touched a little bit on the balanced returns, distributing 9 cents per unit, which as we say is about a 7.1% return on current trading price. NTA increased over the year by 8 cents from about $1.21 to $1.29, in contrast to our listing price 3 years ago at $1. So we've had 3 very strong years where you've seen NTA increase near enough to 30 cents over that period, and 3 years of distributions at a total of 27.4 cents. Total investment during the period was about 14%. We outperformed the ASX 200 by about 8% since the IPO in 2015. Last year was a very important year for the fund. When we came to market, we said the portfolio was still in transition. It was quite a small portfolio, and really what our job was to do was to continue to complete some of the works on the legacy portfolio, increase the scale and the diversification, and improve the quality. I'll show a slide shortly that sort of shows the increase in WALE, the reduction in cap rates, and those sorts of things. So it was a very important year, particularly in the context of acquisitions and sort of divestment early or late in the prior financial year. Capital management, you'll see that ANZ was brought into the fold as one of our lenders and increased facilities there by 30 million, and that related particularly to our 2 acquisitions at Pinkenba and Waco. To the actual results themselves for the year, there's 2 or 3 sort of key numbers on this page. Distribution payout ratio, which was about 100%, the tax deferred at 63%, the NTA at $1.29. The distribution payout ratio at 100%, higher than we'd like it to be off the back of a project that we're undertaking in Victoria called BOTANICCA 9, and so effectively we've got equity contributed to a project that's currently under construction, and we'll see that project complete late in the second quarter of the current financial year. Normalising back out to the low 90% is where you'd expect your payout ratio to be. NTA movements through the period, as you can see, predominantly off of the revaluations. A couple of negatives there in terms of stamp duty write-offs and interest rate swaps, sort of paper movements. But otherwise, again, a solid year of NTA increase off the back of valuation improvements across the portfolio. This slide gives a pretty good indication of how we've seen the portfolio perform and our job to transform that portfolio over the last 3 years. Still a little bit of work to go in terms of continuing the diversification of the portfolio, but you can see quite a substantial increase in WALE from sort of 3 years through to 6, and the NTA, as I say, from $1 through to $1.29. That cap rate compression isn't all just across the market. That's a result of some of the assets that we've owned coming into the IPO that were divested, reducing that cap rate down, but is also very indicative of the tightening markets across particularly the commercial markets in Melbourne. Occupancy, as you can see, stays reasonably steady around that 95%. I'm just going to skip through to we'll go to the ASX REIT 200 slide. We talked earlier about the outperformance over the last 3 years of about 8% to the 200 index. This slide, albeit it's slightly dated, done to the 21st of August, and there's a little bit of corporate activity that changes some of the pricing on here. But in terms of comparing GDF to some of its peers, Again, you'll see that the yield is at sort of the higher end of the range. CIP there at 6.9 was before that corporate activity, and you'd see that yield lesser today. Whale at 6 years, you'll see is again right at the top end of that position, and that's something that's a key driver for us. And again, trading on that day a little bit under NTA, whereas I think yesterday we closed just a little bit over NTA. And again, gearing sort of sitting around that 37%. Our long-term gearing range is really around that 30 to 35%. I'll probably just very quickly touch on the 2 or 3 acquisitions through the year so you can get a sense of what we were buying and doing. The first property that we have here is out at Heathwood. It's about a $10 million industrial asset that we acquired in April. As a 10-year lease, it was a triple net lease and acquired on a 7.4% cap rate and 4% reviews. Just a good little property, full concrete hard stand, undercroft parking, built by an owner-occupier, so to quite a good standard, and in a great location out at Heathwood. So it was a nice, neat little addition, not a lot of risk, but a good return on that asset looking forward. The next one was at Wacol, the Metroplex Westgate. This is the old Wacol Army Barracks out there on the freeway. So Volvo, this is their national headquarters for Volvo Trucks Australia, 10-year lease out here, $35 million transaction. Now this was one of the 2 transactions we did on a capital fund through with the developer, and this settled in May of last year. Cap rate of 6.25%, albeit on the fund through there was some stamp duty savings and benefits to that yield as we look forward. A very impressive facility, an unrepeatable location, and certainly a high quality tenant. The second fund through transaction we did for the year was the Pington Bar transaction. This was about a $19 million facility. This is out on Main Beach Road as you head out towards where the new cruise ship terminal is being developed by the Brisbane Port Authority. This building out here is going to be used as a soil transfer facility, so it's a recycling facility for materials, soil, rock, gravel and the like. 15-year lease, triple net lease. It is effectively 4 hectares of hard stand and a 2,500 metre shed, and it's in a great location, improving position. So again, about a 7.4% yield that sits into the portfolio. The last one I'll talk very briefly about is BOTANICCA 9. So this is a commercial project that we're undertaking in Melbourne, the BOTANICCA Office Park. We already own a building in there, literally 2 doors down, known as BOTANICCA 7. This building will be about a 7,200 square metre A-grade building. We're well and truly into construction at this point in time and expect construction to be completed in the second quarter of the current financial year. Why are we building a building in Melbourne? City fringe Melbourne office market is extremely tightly held. There's about 3.5% vacancy across that market, and anything over 1,000 metres, about 2.5% vacancy. If you're looking for 5,000 metres of space or more next calendar year, there's pretty much this project and no other, and we continue to see a tightening in that occupancy and an increase in rent rates throughout that period. There's other supply that will come on, and most of that is in the back end of FY20 or FY21. So this is a substantial project for the fund. Will be substantially accretive to the value and the quality of the portfolio. And our mandate to undertake the project was really considering the return on cost that would be achieved on that particular building going forward.